Hey, it's Water Cooler Wednesday. Hey, guys.
What's up, Dion?
Hey.
Water Cooler Wednesday, Water Cooler Wednesday. We got to make up a song about this.
I know we're gonna have a theme song behind us. Like, yeah, and
Right.
we have our little house music.
WCW.
Right.
WCW.
That's next. Watch out. More a theme
It's
song.
time for the water cooler. It's time for the water cooler.
Right. Hey guys,
There
hello,
we go.
hello. Thanks for joining us. So today is me, Dion Branch, with Real People Realty,
Yeah.
and also joining me is my co-host Lisa Williams White.
Hello, everyone. Lisa the Lender, House Money Mom in his head.
Yes. Thanks for joining us. We asked you if you could please share. So just share this live,
Like and share. Like and
and
share.
share. We really want everybody to see us, see what's going on. So we asked you to join us. Thank you. So, and send us some chats if you have questions. Let us know. Just send us a message, and we definitely will be able to answer your questions while we're live as well. So today we're going to talk about money investors versus homeowners. So we have a lot of friends out there that are interested in becoming investors. And so the first thing with all home buying processes is that we have to start with the lender, and we have to understand where your money is going to come from as being an investor. So that's why we have the house money mama here.
That's right.
She's going to tell us all we need to know about investing. So investing and how can we finance our home?
Right. So, I agree with you. I've been hearing a lot more about people that want to get into investing in property. What are those shows like the Flip That House or whatever? What's the name of some of those shows that come
All
on?
the HGTV shows.
Right,
Yeah.
HGTV. They got all these
You
people
can
on.
invest in 30 minutes.
You can invest in 30 minutes. I haven't
Right.
heard
That's how it is. The HGTV shows, right? Like they make it look like you invest in 30 minutes, right? Because you watch a show,
right.
you're like, whew, that was so easy. I could do
True.
that. Yeah.
Exactly. And you don't get to see all the stuff that goes on in the back end, as far as the longevity of the project, as far as what it takes to be able to get the things that you need in order to make the transaction happen, and all of those kind of things. That all of that's
Right. Things that happen while you're going through issues with contractors. So investing is, I don't want to say
it's not for the faint at heart. Let's say that.
yes, right. There are a
And
lot
if
of
you're a
different
newbie, I was
go
just
ahead.
gonna say, if you're a newbie, you want to do as much research and everything as possible, and potentially get a mentor,
Yes.
somebody who's actively investing, not somebody who did it back in the '90s, because this is not the '90s market.
Yes,
So,
and later on in our coming series, we're gonna bring some investors here, people who have experience with investing, and let
and
us
that's doing it right now.
right,
Doing it
that
now.
can give you some tips and
Yeah.
tricks about investing because I have a story about an investment property. We call it a pig with a blanket. No, with a pig with a beat face. That's what we call it. A pig with a with a beat face. So there's a
Okay.
lot. There's a lot in order to when you become an investor. But we want to start out today with Lisa, where they get their money from. Like, I
Right.
mean, there's always cash. cash is gold, right? You
Yeah.
know, you can always have cash. If you have cash, that's a great way to start. Maybe start small, on some, maybe like a condo or something, and build from there. There's a lot of different opportunities. There's a lot of properties out there that you could purchase with cash, and then use your cash and fixing the property up. So
Mhm.
there's, cash. If you have cash, that's great, right? But everybody doesn't have that. Everybody's not that, you know.
Right.
Yeah.
Right.
Hmm.
So then for the people that don't, you got to look at how can you finance the deal then, right? Because now
Yeah.
I don't have $100,000 sitting in my account to be able to acquire this property and then be able to fix it up and flip it or hold it, because some people hold the property and act as landlords, or maybe help somebody, like say, for example, I know a couple of different companies where they do rent to own or rent with option to buy. And so for that, you have to have the money for acquisition. You need to acquire the property, get it to the standards that it needs to be at, and then have a little bit of money aside as well, just for things that may come up that you may need to address while the tenant is in the property until that 2-year period is up, where they're going to purchase it at the end of that 2-year period where their option ends. So, but in the meantime, we're kind of like at the beginning where we're talking about financing. How are you going to finance the property? So it's a couple of different ways you can do it. It's more than a couple, actually. So you can do private money, like kind of what you just talked about. That would be where people would come in with their own cash and they will help you finance a project. Sometimes that could be from people that you personally know. Sometimes they're like angel investors and things like that. If you get involved with the real estate investment association or club, they may get you in contact with people who are willing to do that kind of thing because they get a better return on their money in the real estate field than what they would do in the stock market. So a lot of times people consider it less risky and they like the higher return. Another way you can do is something that we call hard money. Hard money is really more like for those short term type of transactions. So hard money people are like this. If your deal makes sense, then I'll fund it. So
Right.
for example, now, but you got the thing about that is though, you got to have some skin in the game. Most of the times with hard money, they want you to put 20% down. So
Right. They're looking for people that have good credit,
mhm.
and also you have to have some project managing experience already. So you
Not
already.
all the time. I have a few hard money lenders where the experience is not required, and actually,
Okay.
I have some that are now going down to a 620.
Okay.
But on the 620, you may have to put down a little bit more than a 20%. You might have to have more skin in the game than what you would as if you had, like, say, maybe a 660 or a 680.
Mm.
So it's still ways to be able to get stuff like that done. But with hard money, you're going to be looking at a couple of different things. One, don't think in terms of the regular market. Okay. People out here saying, oh, we know interest rates is in the threes and stuff like that. For hard money, no, it's not. For hard money, this is something where your interest rate is probably going to be like eights, nines, maybe even tens. It depends. But you have to think of it. They're giving you this money for a short amount of time so that you can get your project completed and then turn over that money, give it back to them so they can now use it to invest in something else. So it's really designed to be something that's more of a short-term thing. It's something where maybe like a 6-month to a 12-month project. I've seen them do 2 years, but
Mhm.
yeah, usually it's a prepayment penalty and stuff like that because they want to make as much money as they can off of it. So keep that in mind.
So you're saying that, so a lot of the hard money lenders that I saw, you kind of had to have your project done within like 3 months, and then they'll start to charge you the higher interest rate. So maybe like you might purchase, you have to put so much down in the beginning to purchase,
Mm-hmm.
and then you have 3 months without any payments.
Tiny
But then,
payments, yeah.
right, and then after that, within that third or fourth month, your payments then have to start. The thought behind it is that you've finished your project within 3 to 4 months,
Yeah.
and your house is on the market ready to sell, because you're kind of doing it as a flip. Or
Mm-hmm.
maybe they might decide that they want to refinance. Some people I've seen do hard money at first purchase the property and then refinance it afterwards.
Yeah, yeah.
Right. But to tell me if I'm doing wrong, right? Lisa, you know.
No, no, no. You good. You good because that's true. A lot of times, for most investors, that's their exit strategy. That is
Yeah.
their long-term thing. They get that money just so they can get the project done. Once the project is done, then they move it to the next phase by refinancing out of that high interest loan into another loan. They may even scrape some of that money. Like, say for example, if they did something where they're holding and there was a little bit of equity built up between the time that they
Yes.
took the project initially and they finished it, they may take that money out and use that to go and fund another project.
Right.
So I mean, it's a couple of different ways that you can look at how to do that. But yes, absolutely, no, you're right. You are
Mm-hmm.
right.
Right.
So that is, hard money is definitely one of the options. Now, people can still use conventional financing to be able to fund their real estate investment projects, though. I mean, so FHA, let's talk a little bit about FHA versus conventional, okay? Because I think sometimes people get these things confused as well. They think that they're basically the same kind of thing, just one is government and one is not. That's not 100% true. So with FHA financing, FHA is designed for people to own or occupy. So that means I'm going to live in the house that I buy. I'm not buying this for an investment. I don't intend to rent it out. Unless, of course, it's a multi-family, then, I will live in one of the units and I may rent out the other units that are part of the property. But FHA is designed to encourage home ownership. Well, this is where I'm going to live. This is my primary residence. So FHA is not really something that's set up for you to fund your investment project. Again, unless, like we talked about, you live in one of the units and then you rent out the other units, then that's something different that you can do that. Now, as far as conventional financing, though, you can use conventional financing to be able to acquire a property. You can even use it to do rehabilitation. So just like how people usually hear about the FHA 203K, that's your
Right.
rehab loan, right?
Right.
Well, conventional does rehab loans as well. So you can buy an investment property, like let's say, for example, you find a really nice single family home, it's $200,000. You want to purchase a home and just basically rent it out. You can do that. You can do that with conventional financing. Now, same thing as with hard money, because this is investment. This is a business now. That's how the lender looks at that. That's how hard money lenders look at it. That's how any lender is going to look at that. When you buy an investment property, you're basically saying that now you are a business owner, that this is something you're doing to generate income. So because of that, the way that they look at how to structure those deals and the amount of skin in the game that they expect you to have is way different. No down payment assistance for investment projects. It's not going to happen because, they don't expect that if you're starting a business or continuing a business, you've already done some investment before, that you would need help to be able to do that. When you go into business, you go into business. So you need to, be resourceful. You're an entrepreneur, Dion. So, you got to be resourceful and we got to figure it out. It's
Right.
not about anybody holding our hand or helping us to do anything. We got to take our own tests. We got to get our own tools. We got to find our own resources. We're entrepreneurs. We make it happen. That's what
Yeah.
we do.
Right. So a lot of people are trying to find a way of getting some money towards it, and we're just saying that's not happening, right?
Right.
A
Right.
lot
Exactly.
of
Exactly. Yeah. So you have to be prepared with that money that you're going to have in for your skin in the game. You're going to have to, be ready with that 20%, but you can do it with conventional financing. Now, the cool thing about that is if you did use conventional financing, then you also have the ability to do some of those more traditional type of mortgage loans. Like you can do a 30-year mortgage loan and you can have the interest rate that's, maybe high threes, somewhere around there, which is more like, what the rates are today, as opposed to a hard money rate, which of course, like we just talked about, could be 8, 9, 10%. So
yeah.
that is kind of one of the benefits. You can be able to do it that way. Again, it's still 20% either way. But if you can qualify conventional, then it's something that you can do and take advantage of the interest rates that are more like what the market is right now, as opposed to having to pay the higher interest rates for like a hard money loan or private or something like that.
Right. Now, we have talked a little bit about, we did just like mention FHA, right? And
Yeah.
so some people have purchased their first investment property with FHA financing, and but there's some requirements, like you have to live in the property for at
Yes.
least like a year or whatever, right? Like what? So
But that gets to be a little bit tricky. I don't know, because I know there seems to be some kind of idea about what you can do after staying in it for a year. But FHA financing is designed for you to be in the house. So
right.
if you stay there for a period of time and then you try to use FHA financing again for another house, basically to invest, that's really considered mortgage fraud. We don't want people using FHA financing for your investment as your investment vehicle.
Mm-hmm.
So now there are some exceptions. Like for example, if you get an FHA loan and you get relocated 150 miles away from wherever the original place of residence was, and you can't get out of that first FHA loan, but you can afford to take a second one out in a new place, they'll let you do it. You're relocating. It makes sense. Same thing if you start off in one place and then say your family size. Maybe when you first moved into the place, it was just, you and the hubby. And then, hubby and wife do what, hubbies and wives do. And now so
And now we
now the family has expanded. So maybe we might need more room, or maybe we want the child to be able to grow up with the backyard and, or better school, whatever. So in a case like that, you could definitely make a case with an underwriter that it makes sense why you would be getting another FHA loan. Like if you weren't able to get rid of that one, but you were ready to move right away and you wanted to
yeah.
get another FHA loan, you can make a case for that, because then that would make sense. Other than that, you probably want to either refinance out of that loan or, sell the house, something. You need to do something with that other loan, because otherwise, if it doesn't really fall into the exception category, then the underwriter is going to look at it and be like,
Right.
I don't think so. We ain't
Right.
going.
So maybe they might buy the first one with FHA, then refinance it as a conventional or something like that. Or you buy the first one FHA, and then anything else you buy, you have to buy it with hard money or
Oh, right.
conventional.
Or
Right.
conventional.
So
Yeah.
right.
Yeah.
So there's there's definitely some options. Um,
The biggest thing is that, keep in mind, FHA is for owner occupancy. So you don't want to, get an FHA loan and say that you're going to live there and then not really live there. We don't, you don't want to do
right.
that.
Yeah.
I don't know that they send people in black suits to your house. I don't think they do, but just for integrity's sake, we want to be people
Just
of
in case.
integrity. Yeah,
Right.
don't
Just
do
in
it. If you're looking for FHA loans, because you want to live there, not
case.
because you want to invest. If you want to invest, you look at the conventional hard money or private financing in order to be able to get the place that you want.
Right. So, there's, as people are trying to get into this, and maybe this is their first deal, is there
Yeah.
any one way that you say maybe easier for the new buyer just starting out?
Mm, That's a good question. I would think as a newbie, first again, like I was saying, just as much information as you can get. You really need to do that. Do your homework, because real estate investing is not for the faint of heart. People get out of it for a reason,
Yeah.
especially after they've been in it for a while. They get out of it for a reason. There are a lot of risks involved, and you have to know know thyself, as they say. Like what your risk tolerance and level is and everything. You definitely need to know that. But then also you need to have a definitive plan. You have to think beyond just what you see on the TV. You have to also think, okay, what is my end game with this? How am I going to get out of it? If that initial plan for end game is not going to work, then what would be a secondary option that would still be just as viable, so that I can, achieve the goal that I'm trying to achieve. Obviously, the easiest thing is if you just have enough money or pool enough money from other people, in order to be able to get involved and acquire the property. Because a lot of times hard money will If you have the initial amount down, they'll fund a certain amount of the acquisition, like 80% of the acquisition, and then they'll fund 100% of whatever that cost is for you to rehab the place. So fix and flips is probably easier because they'll fund so much of the deal. It's the buy and hold, I think, that gets to be a little more difficult. If you want to get into landlording, I don't think you should do that as a newbie. I think you probably should wait on something like that when you have, funds aside to really be able to sustain that debt.
Right, right. And then there's a few people that we can also bring on about property management
Yeah,
in the next few weeks. So this week, these month, we're probably going to talk more about investment, share more information with you about how
yeah,
to become an investor, and just give you and bring some different resources to you concerning investing properties and all the things that you need to know, just an introductory. So um,
right.
we look forward.
Investors. So who we have? We have some investors. We'll have who we talked about somebody else to bring on too, right? To
We
be
have
able
property management,
property managers.
investors,
Yeah,
mm-hmm,
yeah, that's the main thing then. So,
right,
and if
and
anybody,
contractors.
oh
And
yeah, I was just gonna say if anybody's on the contracting team, that would be good too, because then that way they can give us the skinny on, the inside of the project itself. The hammer and nails part.
yeah, right. And why we think it should only cost $5, and they tell us it costs $50,
Right.
right?
Right. I don't know if you know the cost of lumber has gone up. I heard a report on that just a few days ago.
Yeah. So last year we built a deck, and we're so glad that we built it last year. So
I can
right,
imagine.
it's definitely gone up. So
Hmm.
guys, I don't know, Lisa, you have anything you want to wrap up with today?
We're good. No.
All right. So
Yeah.
we thank you very much for joining us at this water cooler. We want to make sure that we share everything with you as far as the home buying process, and investment property is what we're talking about this month. So, my name's Dion Branch with Real People Realty, and we have, ooh, I was trying to put your
Lisa the
name up.
lender, the house money mama from Geneva Financial.
Yes. So, follow us on the Water Cooler Wednesday Facebook group or on our private pages. So we look forward to seeing you. Thank you for joining us. Bye.
See you later.
Bye.
Bye.